Welcome to the Greenleaf Podcast. Today, we are digging into the operational aspects of retail. It is that time of the year again, so end of quarter, and we're going to have a couple updates going out around the different segments we're in today. We're going through all things retail, so we're excited to get things kicked off. All right, a couple things we want to talk about. First, talk about debt. We're going to talk about the CMBS market. Not that we're in the CMBS market, but is a good indicator of how loans are performing. And you can simply Google any of the CMBS markets and look up retail, multifamily, office, and see how these loan pools are performing. CMBS, commercial mortgage-backed securities. So if we look at the retail front on CMBS, it seems like it's trending in the right direction.
Yeah, so CMBS is really characterizes really the whole mortgage industry outside of really Fannie and Freddie. So when we go get a loan, we're mostly going to a community bank or a life company, but CMBS is really the only option on the commercial front to take out a loan when you're not in the multifamily business. In multifamily, you can go to Fannie and Freddie, but for office deals, for retail deals, you have to go to CMBS if you want to get away from smaller banks, if you want to have sizable loans.
Or the banks don't want to keep that on their balance sheet, so they've got to securitize that to move it off their balance sheet.
Exactly.
Right? So currently, retail delinquencies in CMBS, I mean, they peaked during 2020. Obviously, at that point, people are like, wow, retail is over. It's not over. And it's been trending in the right direction ever since then. So now it sits at 5.3%.
Yeah, the lowest level since 2020, and it's continues to trend downward. Retail is performing incredibly well from a mortgage standpoint.
And there's also a reason for that too. Retail is one of the most predictable performing assets there is, whereas our expenses and everything is pretty much fixed because it's on the tenant. And so as far as the performance of a retail deal, we can predict it pretty reliably. And one of the things we can predict is whether we're going to be able to pay our debt or not. So, makes it easy on us.
We don't necessarily use CMBS loans. Mostly all of our loans, if we have a loan on retail, is held with a community bank. So that bank issues the loan to us. They underwrite Greenleaf and us personally, and then they hold that loan on their balance sheet. CMBS is obviously going off the balance sheet. So, but CMBS in the data that it has is a good indicator of how a certain market is performing. So CMBS for retail the trend line is going down on delinquencies, which is good. Whereas we look at some of the other stuff, offices is trending up. We know that. And so is multifamily. Multifamily is up to 3.3% right now. So it was around 1.9% at the beginning of the year. So multifamily is trending up. Variable rate loans and makes it a little bit challenging in that space with what rates have done over the past 12 months. So obviously that part is trending up, but CMBS for retail is going in the right direction.
Yeah, the multifamily, we can talk about this more in our multifamily segment, but it was interesting because if you looked at actual delinquency in terms of people not making their payment, it was 3.3%. But the more interesting was that it was actually double that high for loans that had expired. So it was closer to 7% for loans that had expired and have not been refinanced, have not been paid off, and that banks are basically sitting on their balance sheet with basically twice the amount of delinquency that they're reporting.
Well, the CMBS part.
Right, the CMBS part, right.
Yeah. It's kind of that kicking the can down the road a little bit further, and it's coming into office and multifamily.
And I forget who actually talked about this, but at some point we talked about multifamily, and multifamily keeps on trading higher and higher and higher. And at some point in time, there's some buyer who's holding the bag at the very end. And I think we are actually at the place where
there's going to be a few of those out there. At least that's our viewpoint.
Yeah, there's a few people holding the bag, or the can can't be kicked anymore. And then,
So if we look at retail, so we covered CMBS, and we just want to talk about like the volume in the market right now. There's a lot of different reports out there. You can go see what the volume of retail transactions are that are happening. And we went through different data sources, and we're like, okay, maybe it's a 73% decline year over year. Maybe it's 50%. There's different numbers on that when you look at volume, either number of transactions or volume dollar of transactions. Hard to inflation adjust those transactions, but
they're all down.
But somewhere between 50 and 70% is still a significant decline, right? Most of that, what we're seeing is people are just not selling it. They're just holding it.
Well, it's the same thing for us. You don't want to sell an asset at a loss. And so one of the basic premises of real estate is time will cure a lot of wounds. And so if there is something happening right now with price fluctuations, you hold on for 3-4 years. I mean, you're fine. I mean, that's what happens. And so sellers are taking that strategy, would be my guess.
Yeah.
including us. I mean, we're
Yeah,
not.
well, I mean, you see a little bit of interest rates starting to creep down, and you're getting like, "Ooh, it's gonna get more exciting again." And I think
Yes.
people are just holding out. They're like, "Look, we have a longer term lease. We'll hold out for another year or two, see what rates do, and then if we're interested in selling at that point, we'll look at a transaction then." So
Yeah, well, a good example of that is one of our Applebee's, right? It's like we just got the loan renewal, or we got the lease renewal, and we're looking at saying, okay, investors are making 7, 8, 9% cash on cash. We could sell it right now and make a little bit of money, or we can keep making 7, 8, 9% and wait for interest rates to come down, wait for cap rates to come down, and sell it at more of a premium. So we're saying, you know what? There's no urgency to sell this deal. We just got a lease renewal. We're in a really good position. Let's just keep holding.
yeah. So all right. So those two pieces tied together. When we think about just how the market is performing as a whole, we definitely see it as still as a buyer's market. There's not a lot of transactions out there to be had right now. Debt is still expensive. I mean, you can get debt, but you're going to be paying 7.5%, right? That's kind of the market we're seeing out there.
Right, and you
right
can't
now.
buy deals at a 5.5 cap and get 7.5 cap debt because I mean you just can't do that. You have to buy those deals cash right now, the 5.5 cap deals. But if
Yeah.
you're going to buy a 7.5% interest rate, I mean you pretty much have to be at like a 8-9% cap rate because if you don't do that, your deal just doesn't cash
Yeah.
flow at all.
Unless you feel like you've got a really good piece of real estate, you're happy with a 5.5 cap. You're not going to need debt on it.
Yeah. Or gas
Um,
stations, or there's other reasons like people who buy gas stations want the accelerated depreciation. So there's other reasons to buy those
Yeah.
5.5 cap deals. If you have some losses that you want to offset and you want to depreciate a big percentage of the asset in the first few years, you buy a gas station.
Yeah, it's the same with the car washes. That's more of a tax play where you're going to get a large write-off year one. We don't, in the retail transactions that we have, we're not seeing those giant year one depreciation factors. So that's not a reason that we're making an investment. Also, we're not buying gas stations or car washes right now.
We're buying deals that cash flow.
Unless that turns around and there's a reason to do it. But right now we are not. So,
Yep.
But all right, so that's kind of a little bit where we see the market. So we still think it's buyer's market, although debt is expensive, right?
Let's lose track of that. We're also in a buyer's market, but our thesis right now is we're at the bottom of the buyer's market because as soon as interest rates tick back down, prices go back up. And so
Yeah.
literally prices have been going down for a long time. And we're buying some stuff right now. We're buying a portfolio that we'll talk about. And if we're not at the bottom of the market, we're literally at that bottom curve of the market right now because real
Right.
estate's always going to have its little ups and downs. And
Yeah,
so
the debt rates are going to are trailing. So
Right.
even if interest rates are adjusted down, they still take a little bit of time for that to get through the system. Banks just go out and instantly loan at lower rates because of that.
Right.
So, all right, so let's go through just some of the operating numbers we have. It's obviously the end of the quarter, so we are 3 quarters into the year. We've got a pretty good idea where our numbers are going to come out, and we always like digging into the super statistical pieces of how things are performing. One of the metrics we use here a lot at Greenleaf is kind of how we base our performance is operating return on assets. So we're looking at what is our net income coming out of deals based on the asset value. The better we keep doing, the better we perform, the higher our operating return on assets are going to be. So we saw our margins really in the third quarter. We look at 3 quarters out of the year right now. Our operating margins are up 19% over the prior year. You may wonder, like, okay, how are operating margins changing that wildly when you just stated that it's pretty fixed? But we do have double net leases. We do have leases where we're responsible for landscaping. We have some leases where we have to cover the parking lot or a roof repair or things like that. So that is part of the operating picture of where we're at. Our operating expenses right now are around 6.5%. So they've been good for 2024, and it's trending in the right direction. So that means our profits this year are up 19% on the assets that we do have. Let's go into some of what that looks like on deals specifically. So looking at the hurricane stuff, and we are in the Southeast. So all of our deals, feels like all of our deals are in the hurricane. Everything got rain in the past 2 weeks.
Yeah,
Everywhere in the Southeast.
The whole story of like we buy mostly along 85. The hurricane literally just rode the highway up.
Yes.
And we had 4 deals that were actually in the hurricane path. And the good news is, well, we had one of the locations we're buying right now, Dollar General in Hepzibah, Georgia, and then DG Middleburg in Florida, and then our 2 Applebee's in South Carolina, Aiken and Sumter. And good news
Yeah.
is we had a little bit of damage at Hepzibah, but everybody else seems to be doing okay. So
Yeah, and
that's the good
everything's
news.
back and open. We didn't have any
We had no roofs blown off.
no roofs blown off, and that's one of
Yes.
the things that we're
Yes.
responsible for. On
If
certain
roofs blown
things.
off, though, that
through
would be
insurance.
that would be an insurance claim.
Yeah.
Yeah.
Yeah,
We might have some deductible, but that's about it.
right.
Yeah.
But still, yeah, we feel like we were pretty lucky on all that stuff. We didn't have any major damage. All the stores, all the locations are open, so that's that's positive on our viewpoint, right?
Yes.
So,
Good
all right.
news.
Let's go through some of our specific deals. Let's start with the DQ story first of all. So, if you're familiar with Dairy Queen or you like their ice cream,
DQ Grill and Chill is the correct name. So
well, Dairy Queen came out with the DQ Grill and Chill concept.
right. Well,
That-
no, because they're all rebranded now. All the new ones are DQ Grill and Chills.
Yes, but the original Dairy Queen.
It was original Dairy Queen. Yes, it was.
right,
But,
and then now they're calling the new version the Grill and
but
Chill.
if you work in the corporate office, you don't call it a Dairy Queen.
What do you call it?
You call it a DQ Grill and Chill.
Every single thing.
Every single thing.
When I was speaking to Buffett last week, he also affirmed this.
He did
Warren
say-
Buffett confirmed that for
He
you.
called it said DQ Grill and Chill. He said, "Don't
was
call it a
drinking
Dairy
smoothie,
Queen."
Eat his hamburger. He was like,
Nah, he would've been
he's
drinking a
listen,
Diet Coke.
Grill and chill. His mouth was full. It was hard to understand him. But yeah.
But that concept, they changed that concept. They went through a store renovation to do it at our location 3 years ago. Their foot traffic, when we're looking at it compared to now, foot traffic is up about 12%. So it's trending in the positive direction. We've seen foot traffic growth every year that we've owned the deal. So that's positive.
And that deal was brand new when we bought it. When we
Correct.
bought
A
into
A few
it,
years
right?
old,
Yeah.
but it was brand new build.
Okay.
And I mean, it's back to buying, dirt. I mean, this is an excellent piece of dirt in Marietta. I mean, it doesn't get much better
Yeah,
than
Marietta, Georgia. So it's northwest suburb of
right.
Atlanta.
And it's on a 4-lane highway that's really super busy. In fact, one of the complaints is there's actually too much traffic on the road because it's so busy, and so they have to get in. But
Yeah.
those are good problems to have when you have too much traffic in front of your place.
So that's been performing well. It's one of those new concepts that that work well for us. So the other part, if we look at our Dollar Generals right now, our operating Dollar Generals that we have, our foot traffic on those is up 10%. And that's really just up 10% year over year, which is interesting. We know if you follow Dollar General in their stock, they're publicly traded. Their stock did go down. It dropped like 30%. We've mentioned this a couple times around same store sales being flat. But our locations, we're seeing foot traffic that's going up.
We're all in on Dollar General right now. Even personally, we've both invested in Dollar General stock,
Yeah.
so we're both believers.
Buying the dip.
Yeah,
We're
buying the
dip.
dip.
We're buying the dip.
So
Both in real estate and in stock.
Yeah, so we've seen that those stores have been performing well for us, and they're seeing foot traffic growth year over year. So we like that. But it's also a testament to we feel like we're picking locations that are going to be high performers, and that seems to be showing at least our year over year data right now.
I mean, Dollar General's operating team has been exceptional over the last 7 years. They've added 35% store count. They went from 12, 13,000 and 19 plus thousand stores. It's incredible, and it seems like we're at the right moment in time for them to kind of maybe adjust sizing, maybe look at where they're spending a little bit more, maybe where foot traffic's down, and maybe adjust there. And that's why we are hypersensitive to this foot traffic data. And looking at rents.
Right, because at some point they're going to start to close the poor performing stores, the ones with high rent or poor performing, and we don't want to hold one of those stores. So we're always buying the stores in the low rent sector, high foot traffic. We even have sales data now that we can actually pull, and so everything we're buying right now checks all those boxes. Yeah. And here's the quiz of the day. You know how much cash Dollar General has on its books right now?
Did that come up at your lunch with one? But no.
With Buffett?
How much is it?
When you met with Buffett, did that come
what's
up?
the quiz show answer here?
Okay, you don't know the quiz show answer?
I don't know.
$400 million. So they have over
That's a good amount of
$400 million on their balance sheet. So, I mean, they've got some cash to do some
Yeah,
stuff
we'd
with.
have to go look at if the trend is up or down. Are they conserving?
Yeah,
I mean,
it's up every year. Every year their cash balance goes up pretty much.
And they're paying a dividend too.
Yeah, and I was just thinking about that. They have $400 million in cash. They could They could open up $400.
You got 19,000 stores, 400 million. I mean,
yeah, it'll go quick. It will go quick if something happens. But
yeah,
it is a lot of money.
So, all right, so we're going to touch on some stuff too. Not everything is always perfect. So we got two other ones we want to talk about. Applebee's, we track their same store sales. If you follow the trend of Applebee's over the past couple years, they did go bankrupt. That was publicized where they did go bankrupt. They had to close some non-performing stuff, and then when that happened. During the bankruptcy, there's locations were trading at pretty high cap rates. When they came out of it and they started performing better, the cap rates on those real estate locations went down. That's when we were able to buy. We didn't necessarily buy the low ones, but we bought pretty high cap rate Applebee's. And with the trend that they're going to keep improving operations and doing pretty well, over the past year, they've seen same store traffic decrease. Whereas, we're saying DQ, Grill and Chill, Dollar Generals have increased. We've seen about a 7 to 8% decline on Applebee's foot traffic, and when we look at a lot of the locations. So that's a trend where you're saying, okay, they still have a lease that's in place. They're still performing well. Their foot traffic is still up compared to many years ago, but it was off of last year. So we're looking at that trend and seeing if it will impact us going forward. It's also trying to figure out how do we look at just the top performing locations and get those. We're always in favor of if you can have a top performing location, that's where we want to be. But that's the trend we're seeing on Applebee's right now.
And our Colleen store in Texas, and then our Seneca store in South Carolina, those are both top tier. And even our Lithia Springs store, those are all top performing.
We look at Colleen, it's near a military base. It has a very good location where it's one of the top performing. We looked at like alcohol sales that are in a franchise, and it's doing very well. So not all stores are exactly equal, but you do have to look at what the brand is doing as a whole and what the stores are doing purely on foot traffic. How it compares year over year, maybe a starting indicator. How it compares over a 5-year period. You have to look at all those trends to assess where you're at. So that's what we're seeing on the Applebee's front. Interesting part on the Family Dollar. So we got a Family Dollar here in Atlanta, and this is a situation where Family Dollar is, they're a lease where we do have some responsibilities. We're responsible for the roof in that location. So we have two things that happened this past quarter. When we purchased it, we knew we were going to have to fix the roof and make repairs to it.
We had some issues with the roof when we bought it, but the actual...
But we knew that.
We fixed it, and then we thought we were done, and then we had some surprise issues that we did not expect, and so then we had to kind of price the repairs because we've had too many repairs over the years, and we got some pretty bad news. We got some bad news about $30,000 to $40,000 worth of basically sealing the roof, so putting a big silicone steel on the roof. But we, after internal, just some discussions about what to do, instead of just sealing the entire roof, we're sealing every single, any single, what do you call it, I want to say penetration, but like any sort of hole, any sort of penetration.
Yeah, kind of problem with you have a TPO roof where on the roof, TPO is great when you don't mess with it.
Right.
But as soon as you start cutting holes in that thing, you have HAC contractor that goes up there over the years. They cut a new hole in the roof, put a vent in it. You have all these open spots you're just creating weaknesses in the roof. And that's all the areas where you're either going to go put down a whole new roof to secure all that, or you really need to go and seal every single penetration location that's out there that you can find to really make sure it's watertight.
So with the Family Dollar, they basically just ran around and sealed every single possible hole, every single screw, anything that resembled some type of penetration hole for wind.
Obvious
for
or even
water.
like, that's questionable.
It was
Let's
all
just
sealed,
get it covered.
And we got it down to $9,000, and we got a warranty on that. So we went from a $40,000 expense to a $9,000 expense. So that was a big win. That's part of our operating costs. When we look at our operating costs going down, it's being able to find solutions like that where we can get up there and get things done for a much cheaper price. Right, and then we also have some obligations around paying taxes. We get to give our Dollar Generals and Family Dollars free, I call it free loans for 45, sometimes 30, sometimes 45, sometimes 60 days. And so we pay the tax bill for Family Dollar, and then we send them invoices and say, hey, please pay these taxes. And then by the third or fourth time we ask for it, they'll pay us. So then we usually have like...
They put it in their queue to get that, to get it paid. But, Family Dollar this quarter, we paid the property taxes.
Which were about $25,000 this quarter.
And we're still waiting for them to send back our tax reimbursement.
Right.
So when we look at our distribution amount for Family Dollar ending in September, we paid the $9,000 for the roof repairs, and we paid out the tax dollars, so that pushed down our reserve requirements on that asset to make a distribution. So we need to have our tax reimbursement funds come back in to then kick out our distribution.
So what that means is
property.
In quarter 4, you'll see an extra large distribution on Family Dollar. It'll be the tax payment catch up and then our normally quarterly distributions. So that'll be good news for all of you.
And that's just one of the pieces that goes into operating what we look at as normally a net lease, but a double net lease or a triple net lease when you use these terms. You can have triple net lease where you're still paying the taxes and then they're reimbursing them to you. So that part happens and it impacts cash flow. That's where we're at with that one right now. Everything else we have where we do have payment requirements is caught up in current. So we're making distributions on those deals. So the Family Dollar is more of like a delayed distribution because it is working, it is performing. It's just we got the reimbursement time that we're waiting for that.
Yes. Yes.
All right, so that's really the update on all of our operational things of what we're seeing. Retail, I mean, we go back to the summary, the initial statement on this, our operating margins are up 19%. Everything is performing very well. So we're excited about that overall. We go into distributions, right? That's the whole benefit of retail is that you're getting quarterly distributions.
Right.
So we've got that going out the door, except for the Family Dollar that we mentioned.
Family Dollar and Sumter Applebee's, which were having some
Yeah,
tenant issues.
So Sumter Applebee's, we're looking at what is the long-term position of that deal. Every time we go into a retail asset, there's really two ways to make money, right? There's one, I guess we could call it three. You could buy a fully vacant space and you're going to go try and outfit it and get a tenant in there.
Grapes and grains.
That's one. We did
Yep.
that with, right?
Grapes and grains.
That's one way.
Yep.
Or you can buy, what we have done a lot of is buying a shorter term lease, figuring out what the situation is with that tenant, and hopefully it's a longer term renewal. Sometimes it is a re-tenanting process. We're in the middle of that. We're working through that one right now. So that one we're holding the distribution on until we get that figured out. But that is a common, really value opportunity that we go through because there's a lot of negotiation that goes into signing a lease with a retail tenant and figuring out what they're going to do at that location. It's not just, hey, here's the lease, sign it, and let's keep going. There's always going to be some back and forth on this. So we're in the middle of doing that right now. And that'll determine kind of what the long-term prospect of that deal looks like there. But that's something we do on all of our deals, and even Dollar Generals. Most Dollar Generals are like a 5-year lease. We talk about the grapes and grain deal. We have 10-year lease there, so kind of like the time kind of goes fast, though. You sign a 5-year lease, and you're like, before you know it, there's 2 years
5
left,
years,
and then it's like, oh man, we got to get doing this. So 5 years goes pretty quick, right?
Does, yeah.
But so we're in the middle of doing that right now. But
The good news with a lot of these locations is we have bought stuff underneath replacement value. So the tenants cannot move from our location to another location because it would cost them much more in rent and expense to actually move across the street. So
going and opening a new location right now is very expensive.
yeah, and Dollar
Finding the
General
deal.
is spending like $150 to $200 a square foot right now on building locations, I believe, is the data, or was it more?
I'm not sure. We just know their rents are higher.
Yeah, and the
already
rent and our rents are all less than $10 a square foot, and then
Like
those-
the new builds of Dollar Generals, not the fresh market ones, but the regular ones. If you're coming in at like 2.5 million,
Yeah.
or you can buy them for 1 million that are existing. So very different price points on what that looks like to go open a new store and simply like, hey, we're going to close down one and move across the street. That's pretty darn expensive right now to be doing in the retail segment.
Yeah, and these new ones that we're buying batches of right now, that we're looking at in the sub $1 million range, meaning under $100 a square foot. I think when we have a contract at like 650,000,
I
700,000.
have to look, but I think you could be right.
Yeah,
Yeah,
so
so
it-
it's like
$700,000,
$70 a square foot.
yeah,
That's
very cheap.
yeah.
Yeah. So post our distribution conversation, the next part we have is our we've talked extensively about our Dollar General strategy of buying top performing locations with very low rents. I mean, we'd take that strategy and do that with any brand if we can replicate and find that easily within other brands. Buying anything where you can buy the top end of a performer for the lowest financial cost. It's like Moneyball in the old days, right? Like, how do you find the best performer for the best price?
Yes.
That's what we're doing with Dollar General right now. We've got a portfolio of those we're buying. We'll probably get 7 or 10 of these before the end of the year that fit our model and have the best, not only foot traffic, higher cap rates, and we're buying stuff in the high 8s right now.
Don't forget the most important, these are all top performers. So based on foot traffic
Yeah,
and
that's what
some
I'm saying.
sales
They are the
activity,
top, yeah.
we're literally buying the top third of all the performing Dollar Generals with the cheapest rent. So it's like a double bonus in my mind.
So we've got another video update specifically on that trend that we're going through that's coming out. But right now, overall, 2024, third quarter, retail has been performing very well. It's exciting that there's the CMBS declines. I feel like it's bringing some excitement back into the retail space, which is good. And hopefully the positive trend continues to be good news for our segment, all the investments that we have. But right now, we're able to buy stuff and get really good yield. So it's one of those, we hope for higher pricing in the future once we've bought stuff at really good yield. Keep that trend going.
I like that idea.
So
That's a great idea, Dave.
Wait, real quick, going back to Moneyball. I'm Brad Pitt, right?
Okay.
Or
Where
you-
is this going?
I-
Yes.
I'm Brad Pitt. You can be Jonah Hill.
Okay.
He doesn't know about the movie, but
I know about
he's
the
in
movie.
That's what he's talking. He's referencing the movie.
all right. All right.
Using math. Novel idea. Math is really helpful.
Oh, okay, I'll be Brad Pitt.
Okay.
Yeah.
All right. Well, thanks for watching, everyone. Please let us know if you got any questions on retail performance, on Dollar Generals, on Applebee's or DQ, any of the deals that we're working on. We'd love to talk about it. So thanks for watching, and we'll see you. We're going to have much more updates on all of our other asset classes too. So tune in for those as well. Thanks. Everyone.